My name is Vishal Suban and I'm a senior instructor with Sher Khan Education. Today we are going to be looking at the shooting star candlestick pattern. A shooting star can be thought of an upside down hammer or a hanging man. A shooting star is a bearish reversal pattern where the real body occurs in the lower end of the trading range. A shooting star appears at the peak of after an uptrend where the candle has a long shadow above the body and short or non-existent shadow below their body. This pattern is formed when the price of the stock opens, rises sharply, but then closes near the opening price of the stock. A shooting star pattern signals a potential downside reversal and is most effective when it forms after 2 to 3 consecutive rally candles having higher highs. Thank you for watching our video. Let's have a look at an example.
This is the chart of Adani Ports. The stock is overstretched on the upper Bollinger Band. We have a classic shooting star at the upper end of the band. One can expect the prices to come down post such an overstretched move, and the shooting star candle gives the much needed confidence. Look at the way the prices have fallen down post the shooting star formation.
This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.